You did everything right. You researched the fund, you stayed invested for years, you watched your money grow. And then you redeemed and a chunk of it just disappeared. Not to market losses, to TDS you didn't know was coming, to a tax treaty you never claimed, to actually a repatriation rule that nobody told you about when you actually first invested. And this is not rare. NRIs in the UAE, Singapore, the US, the UK, Australia and Canada are losing significant portions of their returns, not because of bad investment, but because of how those investments are held, redeemed and reported. And the part that hurts the most? Every single loss was preventable. This video is going to show you exactly how. By the end, you'll know which tax treaty could bring your Indian mutual fund tax bill down to zero, how to legally reduce TDS before you even redeem, and the 4 questions you must ask before every single investment and every redemption. Let's get into it. But before we get into it, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC and one of India's top wealth management firm before launching my own startup. This is Finicky, where I simplify money the same way I practice it. Now let's start with the single most important structural decision you'll make as an NRI investor. NRO versus NRE account. Before your first rupee goes into any mutual fund, you need to get one thing clearly right. Which account your money should flow through. This single decision affects how easily you can move money back abroad, how it gets taxed, and how much paperwork stands between you and your savings. You have 2 options. NRE account, non-resident external account. This is for money you earn outside India. Your salary from Dubai, London, New York gets converted to rupees and sits here. The important point, everything in this account, principal and returns, is fully repatriable. No forms, no limits, no friction. Move it back abroad whenever you want, and the interest earned in an NRE account is actually completely tax-free in India. Now NRO account, non-resident ordinary account. This is for income earned inside India. Rent from your Mumbai flat, dividends, pension, any money generated within India lives here. Interest on NRO account is taxable in India, and repatriation of capital, your principal, sale proceeds, redemption amount is capped at $1 million per financial year across all your NRO accounts combined. Current incomes like rent, dividend and interest is fully repatriable after tax outside of this 1 million cap. To move out capital of an NRO account, you need to file specific forms with the income tax department and get the sequence right. Banks will reject the transfer if you don't. Get this wrong and your own money can get stuck in India for weeks. Here's how it works. These forms were renumbered under the Income Tax Act 2025, effective from April 2026. Form 15CA is now Form 145 and Form 15CB is now Form 146. The compliance logic is identical, only the names changed. If your total NRO remittances in a financial year are below 5 lakhs, you only need Form 145 Part A, no CA certificate required. Once your cumulative remittances cross 5 lakhs and this threshold is actually tracked across the full financial year, not per transaction, you need Form 146 from a CA first, then file Form 145 Part C online. Then approach your bank. That sequence is fixed, you cannot reverse it. The timeline matters too. The CA process alone takes 3 to 5 working days, then bank processing and SWIFT adds another week. First time NRO repatriation realistically takes 1 to 2 weeks. If you're planning to redeem and immediately wire money abroad, build that buffer in. And if you're repatriating from an NRE account, none of this applies. No Form 145, no Form 146, no CA certificates, just a bank transfer request. The forms, the caps, the sequence, all of that is only for NRO account. The rule is simple. Foreign incomes into mutual funds goes through NRE, Indian incomes goes through NRO. One thing that surprises a lot of NRIs, you can't invest in Indian mutual funds in foreign currency other than through Gift City. Everything must be converted to rupees first through one of these 2 accounts, no exceptions under FEMA. Get this foundation right and the rest of your investment structure works cleanly. Get it wrong and you're untangling it years later when you actually need the money. Next, KYC. As an NRI investor, your KYC status can be one of the 3 things: validated, registered, or on hold. This matters more than most people realize. If you're registered, newer fund houses will ask you to redo the entire process before they accept your money. If you're on hold or rejected, fresh investments get blocked entirely, and you often won't find out until you try to invest and the transaction fails. At which point, you are scrambling to fix paperwork while the market moves. The only status that works smoothly across all AMC in 2026 is KYC validated. Go to CAMS or KFintech right now, enter your PAN and check. If it's not validated, fix it before you touch any fund. You also need an active FATCA and CRS declarations on the file. These are global tax information sharing requirements. Without them, your investments can get frozen during routine compliance checks, again, usually without warning. And for the NRIs based in the US and Canada specifically, many large Indian AMCs don't accept investments from these two countries because of FATCA obligations. Don't assume, verify directly with the fund house before you start. If you're finding this useful, just hit the like button and subscribe. It's a small thing, but it really helps me know that you're enjoying this kind of content and actually keeps me motivated to make more for you. Now, let's get into the next one, how TDS works. When you redeem a mutual fund as an NRI, the AMC deducts TDS, that is tax deducted at source, automatically before the money reaches your account. You don't get to opt out, and here are the tax rates. All figures that you see are before surcharge and cess. The effective rates on your redemption statement will be slightly higher. 20% becomes approximately 20.8, 12.5 becomes approximately 13%. So don't be surprised when the deduction looks different from what you expected. For equity mutual funds, short-term gains, that is units held until 12 months, attracts a TDS at 20%, and long-term gains held for over 12 months attracts a TDS at 12.5%, but only on gains exceeding 1.25 lakhs per financial year. That 1.25 lakhs exemption is an aggregate annual limit across all your equity investments, stocks, equities, mutual funds, ETFs combined, and not per fund or per redemption. For debt mutual funds, if the units were purchased on or after 1st April 2023, the long-term benefits no longer exist. Every rupee of gain is taxed at your income slab rate, which can go up to 30% plus surcharge and cess. If your debt mutual funds were purchased before 1st April 2023, those older folios still qualify for LTCG, which is long-term capital gains tax treatment, if you hold for more than 24 months. A lot of NRIs with older debt positions don't know they still have this protection. And dividends? Flat 20% TDS regardless of the amount. One more thing to understand about how AMCs actually deduct. The statutory tax rate and what your AMC deducts can be different. AMCs often deduct at a higher conservative rate under Section 195. If your redemption statement shows a larger deduction than the rates above, that's the reason why. The ITR refund process corrects this. See, TDS is not your final tax bill, it's an advanced tax collection. If more TDS was deducted than your actual liability, which happens often when a DTAA, that is Double Taxation Avoidance Agreement, applies. You file an Indian income tax return and claim the excess back as a refund. And skipping the ITR means the TDS stays with the government permanently. You do not get it back automatically. But there's actually a smarter move. If you know before redemption that your actual Indian tax should be lower, you can actually apply to the income tax department for a lower TDS certificate, get it approved, submit it to the AMC before you redeem, and they will deduct TDS at the reduced rate from the start. Your money stays with you instead of sitting with the government waiting to come back as refund. Most NRIs never do this, which is exactly why it's one of the most underused tools available to you. Now let's look at the DTAA or the Double Taxation Avoidance Agreement. Even after TDS in India, your country of residence may still want its share of the same gains. This is the double taxation trap. The way out is called DTAA or Double Taxation Avoidance Agreement. India has signed these agreements with over 90 countries. They determine which country has a right to tax which type of income, so the same gain doesn't get taxed twice. For mutual funds capital gains specifically, a landmark ruling in March 2025 by the Income Tax Appellate Tribunal changed everything. The case? Mrs. Anushka Shah, a Singapore-based NRI, earned 1.35 crores in capital gains from Indian mutual funds redemption, a mix of debt and equity funds. The income tax department tried to tax her in India. She claimed exemption under the India-Singapore DTAA. The ITAD ruled in her favor. The reasoning matters for every NRI, not just those in Singapore. The ITAD clarified that mutual fund units in India are issued by trust, not companies. They are not shares. This means they fall under the residual clause under Article 13 of the several DTAAs, which states that gains from such assets are taxable only in the country of residence of the seller. And crucially, this covers both equity and debt mutual fund gains. This ruling has created strong precedents for NRIs in the UAE, Singapore, Kuwait, Mauritius, and several other favorable tax treaty countries. To claim DTAA benefits, you need three things: a tax residency certificate or TRC issued by your country's tax authority, Form 10F filed on the Indian income tax portal, and an Indian ITR filed for the year in which you had the gains. This benefit is never automatic. TDS is always deducted first. You have to claim it back. Now, let's look at what this means country by country. Let's look at UAE. A Delhi ITR ruling in the case of Saket Kanoi and DCIT confirmed that capital gains from Indian mutual funds are not taxable in India for UAE-based NRIs under Article 13 of the India-UAE DTAA. And since the UAE has no personal income tax, a genuine UAE tax resident can legally pay zero tax on Indian mutual fund gains in both countries. Here's what that looks like in practice. Vikram redeems a fund with significant long-term equity gains. His AMC deducts TDS before the money reaches his account. Vikram has a valid UAE TRC, he files his Indian income tax return, claims the DTAA exemption, and gets the full TDS amount back as refund. Net tax paid zero, but only because he filed the income tax return. If he hadn't, the money would have stayed with the government permanently. So what do you need? A valid UAE tax residency certificate, Form 10F, and your Indian income tax return filed annually. See, these ITAD rulings are strong precedent, but they are tribunal level decisions, not settled law. The income tax department can appeal to high courts and sometimes does. So work with a cross-border tax advisor and keep your documentation solid every year. Now let's look at Singapore. The March 2025 Anushka Shah ruling applies directly here. Under Article 13 of the India-Singapore DTAA, mutual fund gains, both equity and debt, are taxable only in the country of residence, and since Singapore does not tax capital gains for individuals, a Singapore-based NRI can legally pay zero tax in both countries. What do you need again? A TRC from Singapore tax authorities, Form 10F on the Indian income tax portal, and Indian ITR filed to claim the TDS refund. Same caveat as UAE, it's a strong precedent, not settled law. The Indian tax authorities has challenged similar rulings. Work with a cross-border advisor and maintain documentations annually. Now let's look at US, the most complex jurisdiction. Under US tax laws, almost every Indian mutual funds qualifies as a PFIC, passive foreign investment company. Defaulted, PFIC treatment is brutal. Your gains are taxed at the highest ordinary income tax rate with an added interest charge. This means you must file Form 8621 for every Indian mutual fund you hold every single year. For US-based NRIs, the commonly used approach is to work with a CA or a CPA experienced in PFIC rules who can actually apply a mark-to-market election which taxes annual NAV gains as ordinary income rather than subjecting to the punishing default rules. Note that Indian exchanges haven't been formally recognized by the IRS for this election, but it's what most practitioners apply in practice. The other option is to avoid Indian mutual funds altogether and invest in US domiciled Indian ETFs for similar exposure without PFIC complications. One thing that's easy to get wrong: if you already hold Indian mutual funds with large unrealized gains, don't rush to exit and restructure. The combination of Indian capital gains tax on redemption plus US PFIC tax in the same year can be worse than continuing to hold and managing compliance carefully. A phased exit over 2 to 3 years often works better. Model the full exit cost before you act. Also, many Indian AMCs don't accept US-based investors due to FATCA, so verify before investing and do not navigate on any of this without professional help. IRS penalties for missed PFIC reporting are severe. Now let's look at UK. HMRC treats Indian mutual funds as non-reporting offshore funds. As a result, your profit on sale is taxed as an offshore income gain at income tax rates, not at lower capital gains tax rate. Basic rate taxpayer pays 20%, higher rate taxpayer pays 40%, and the additional rate for the highest earners is 45%. So India takes its share and the UK can still add its full income tax rate on the top. Most UK-based NRIs are better served by UK domiciled India-focused funds or HMRC reporting fund structures where profits qualify for capital gains tax treatment instead. If you are currently holding Indian mutual funds directly from the UK, speak to a UK cross-border tax advisor about restructuring. Now let's look at Australia. Australia taxes taxes residents on worldwide incomes. When you redeem an Indian mutual funds, declare the gain in Australian dollars at the exchange rate on the date of redemption. There's also a 50% capital gains tax discount. This needs careful handling. The discount is not automatic for NRIs. If you acquired Indian mutual fund units after May 8, 2012 and you were a foreign resident for the entire period you held them, you get no capital gains tax discount at all. But if you were an Australian tax resident for part of the ownership period, you get a prorated discount based on the proportion of the time you were resident. Only if you were an Australian tax resident for the entire holding period does the full 50% apply. Given that many NRIs migrated to Australia after already holding Indian investments, the prorated or zero discount scenario is a question mark. Check your residency timeline carefully before assuming that the full discount applies, and talk to your tax advisor to determine the applicable rate that's applicable for you. Needless to say, you can claim a foreign tax credit for the TDS already paid in India. And keep the exchange rate records for every transaction. The Australian tax authorities actively track foreign income, and undisclosed gains are increasingly being caught. Now let's look at Canada. Indian mutual funds held directly are classified as specified foreign property in Canada. Once the total cost of acquisition, not the market value, cost of all your foreign assets crosses 100,000 Canadian dollars, you must file Form T1135 every single year. So if you have paid 90,000 Canadian dollars for Indian mutual funds, which is now worth 150,000 Canadian dollars, you don't need to file this form, assuming no other foreign assets are with you. It's the cost that triggers the obligation, not the current value. The distinction is counterintuitive and worth knowing. Miss the filing and you face significant penalties regardless of whether you owe any tax. Canada taxes your Indian mutual funds gains with a foreign tax credit available for TDS paid to India. But the reporting obligation never goes away as long as you hold the asset. Again, talk to the tax expert in your country of residence before you take any decisions, because the rules keep changing. I can only clarify India related positions, but better to vet these positions with your local tax expert. Now the 4-question checklist. Before every investment and every redemption, run through these 4 questions every single time. Question 1. Which account am I using? Foreign income goes through a NRI account, no repatriation limit, no forms, full flexibility. Indian income goes through an NRO account, capital repatriation capped at 1 million per year, form 145 and 146 required above 5 lakhs rupees. Question number 2. Is my KYC validated? Not registered, not on hold, validated. Check on CAMS or KFintech using your PAN before investing in any fund. Question 3. What TDS will be deducted, and have I done everything to reduce it legally? Check your country's DTAA position with India. Is your tax residency certificate current for the financial year? Have you filed Form 10F? Should you apply for a lower TDS certificate with the income tax authority before you redeem? Are you planning to file your Indian income tax return this year to claim any refund due? Remember, if you skip the ITR, the TDS doesn't come back. Question 4. Have I accounted for the repatriation timeline? If you're redeeming and planning to wire the money abroad from an NRO account, you are looking at least 1 week minimum. Don't redeem at the wrong time relative to your actual cash flow needs. See, these 4 questions take just 10 minutes. Skipping them can cost you lakhs and a lot of time. Here's what this video was really about. Not the funds, the plumbing underneath them. Because the NRIs who lose money on perfectly good investments don't lose it in the market, they lose it in the gap between what they assume and what the rules actually say. TDS deducted at a rate they didn't expect, a repatriation stuck for 2 weeks because the forms were filled in the wrong order, a tax treaty that would have brought the taxes to actually zero that they never knew existed. Every one of these losses is preventable with the right account structure, the right forms filled in the right sequence, and a DTAA claim backed by a current TRC and an income tax return. The outcome changes completely. India's mutual fund industry has crossed 80 lakh crore in AUM. The opportunity is real, but it only pays off if the execution matches it. Run the 4-question checklist, get your KYC validated, know your DTAA positions before you redeem. These aren't complicated things, they are just the things most people never bother to check until it's too late. If this video changed even one thing about how you manage your India investments, hit the like button and subscribe. Drop your country in the comments and also tell me one thing you didn't know before watching this video. Your questions are literally what I build the next video around. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with Finicky. Thanks for watching, and I'll see you in the next one.